Hey everyone, good morning. So I just read a very interesting article on Bloomberg from Morgan Stanley. They came out and they downgraded all the tech companies. They basically said doesn't matter if it's Alphabet, doesn't matter if it's Snap, doesn't matter if it's Amazon, no matter what the company is, they downgraded all of them. And when I saw that article, it sparked like a lot of questions because we know that these companies are a deep value right now. I mean, so they are already trading at a very attractive price points and attractive levels. So what can really go wrong from here? And I wanted to bring that point, especially because we are in this time right now where we don't know which direction the market is taking. Look, yesterday or 2 days ago, market was looking all green, and we were saying the bull rally is back, or we might have hit the bottom. And I even made a video on that, and I was like, these are all dead cat bounce. These are all fake rallies. Don't really think too much about them because especially the last day of the month, there are so many funds that have to readjust. It doesn't happen all the time, but it does happen where the fund have to come in. They have to buy certain equities because they have so much cash sitting around, they haven't been buying. So all these things matter. But what really Morgan Stanley told us is that according to them, the recession risk has risen from 5% to 35%. So in the beginning of the year, they were saying that we have a 5% chance of recession in 2023. Now they are saying we have a 35% chance of recession in 2023, and that's why they're lowering the price target of these companies. Now, these are big value, big behemoth of companies, right? I mean, Alphabet, Amazon, they're lowering all across the board. And I feel that these companies will eventually do fine. But if the chances are getting more and more harder for recession, as Goldman Sachs now predicting, and I know that we are going to see recession in the next 12 months, according to my calculation, according to the reports that I'm seeing, that we're going to see a recession, a massive recession in 2023 in the next few months. And if the recession comes, these tech names, these highly valued names are going to get really punished. And when I say really punished, that really punished number is anywhere from 10 to 20% where they are right now. They've already been down quite a lot. Another 10 to 20%, yes, it's a huge number when we look at the valuation where we are. Okay, if another 10% Apple drops, or if Google drops, or if Amazon drops, that's a considerable amount, but not 40% or 50% or 60% that some of the other stocks are down. So what I'm trying to say is that these value names still remain attractive to me personally. Again, my opinion, that these value names still remain attractive to me to own in my long-term portfolio. And the weakness that we are seeing, or the reports that are going to come out, because Morgan Stanley is now downgrading all the tech stocks, we are going to see a lot more of the other banks come out and they downgrade these stocks, which is going to be amazing for us investors if you have dry power left. And if you do not have dry power, then this is the time to basically come out and sell the losers, sell the companies that you know are not going to make much money in the coming years, and jump on these names which are going to do well in the next few years. That's what I plan on doing. Another thing to note is that even though no matter who you listen to, they all say that US consumer is very strong. I agree, consumer is very strong. But if you really look deep down, the numbers are bothering me. The numbers that are credit card debt is going up. Delinquency rate is going up. People have less cash in their banks. They are using less debit card for a purchase. I've shared all those numbers, and I'm going to pull out the numbers for May as well now. Now we are in June. So I feel that we are going to see a lot of these things happen as these next few months roll into, because all of these banks are going to start looking at those numbers more carefully, and they will come out and they will say, you know what, no, the consumer is strong right now, but consumer is using more of the revolving credit, more of the credit, and they are not using cash, and that eventually will tend to slow down in the economy, and the consumer will not look very strong. Because what's going to happen, just think about it, right? Like right now, consumer is spending, summer is here, everybody is spending. The credit card bills are coming down or going up. When the credit card bills will reach a certain point where people will be like, oh shoot, I spent too much money, I need to scale back, I need to slow down. And that's when it's going to hit all of us that, okay, consumers is not strong, we are going into recession, the GDP has gone down, and we are going to, so this is all now connecting dots. The video that I made 3 weeks ago about the credit card debt and how The spending on the credit card is up, the pin debit is used, so people, those who use pin to take out money, is going down. That means people are not withdrawing money, withdrawing cash, they're actually taking out more debt. And that is now all coming together in a circle because the delinquency rate is going up. So I am really looking at my portfolio more carefully now, and picking out names that I know is going to hurt right now, but the names that is going to be super attractive in the coming days. The tech companies, the Morgan Stanley warning right now and the lower price target, I look at it personally as an opportunity to own some quality, more of those quality names in my long-term portfolio. We are going to see short-term pain. Definitely, there is no denying it, because when recession hits, these companies will take the blunt and are going to really feel the pain. But these companies have already felt a lot of pain in the next last few months, and in the next few months, even if they go down under 10%, I'm investing in this. The money that I'm using to invest is for long term, is not for short term. So I really don't care if they go down another 10%, and that's me personally, because I didn't plan on cash out on those. And if you are, like, for example, I still have some dry powder on the side, which I'm looking to invest in companies like Tesla that I told you, and I'm waiting for the Q2 numbers, because I have mentioned in my previous videos that Q2 will be a warning sign for Tesla, because their numbers are not going to look good. But their Q3 prediction is going to be massive, because they are reopening. They're at the 70% capacity in their Shanghai plant, and then we will have the Giga Texas and Giga Berlin will be coming out with huge numbers. And I just read report, I think Goldman Sachs, who downgraded Tesla from 1200 to 1000. And all these downgrades are very temporary for a stock like Tesla, because I think Tesla in Q3, Q4 will be a behemoth of a company. But if recession hits, remember, recession first destroys the lower income class, then it reaches up to the middle income class, and then it reaches up to the rich. So I feel that lower income class are not buying Teslas. So car companies like Ford, car companies, other car companies where their combustion engine were in that like $20,000-$25,000 range, that are going to get hit big time. Then they're going to reach, when the recession is at peak, then it's a middle class, then Model 3s might get affected. But people are looking at gas prices too. So there is a change in the thinking that, okay, if I'm buying, I have to buy a car. Let's say my car is broken down, I have to buy a car. Should I buy a gas car which has more maintenance and more money that I have to pay to repair the car? I'm talking about middle class. I'm not talking about lower class. Middle class, they're spending like say $35,000 for a car, or maybe $40,000 for a car. They will start asking those questions, that I'm better off buying an electric car that doesn't require gas, that doesn't require other things that I need to provide, like regular servicing and stuff, or should I buy a Tesla, which is basically no expense whatsoever, just the charging expense is the expense. So these are the questions that they will start asking. So Tesla is at a very sweet spot right now. I think there are few companies that can, I wouldn't say are recession proof, because there are no companies out there that are recession proof, but there are few companies out there that can take recession well. Not like, okay, they have no effect of recession. And Tesla might be one of them. Again, I could be completely wrong, but please let me know in the comments if you think that I don't make sense here. But I think Tesla has the capability of pricing power to a bit, where it works in human psychology, where people think, I don't have to spend money on the car, I'm better off just buying a electric car as compared to a gas car. Same thing like Chipotle, for example, right? I mean, Chipotle is a very wholesome meal for a price where consumers are willing to pay. They might not get guacamole, which I mentioned as a joke in my videos, but I do actually take it seriously. So, but they will still go and have a lunch for like under 20 bucks, which is going to be wholesome, and which is very expensive for me personally. Like when I spend $20 on lunch, that's too much money for me, because I used to spend $10 to $12 on lunch if I would go out from work. So I feel that there are few companies that have the power where they can actually be a recession proof to a degree. There's no company that is completely free from recession fear. Every company will face it, but I feel Tesla might be one of them. Then the other companies are I feel Google is a good example, right? I mean, when things improve, Google will see a huge advertising coming back, where companies will start advertising. Companies already have too much stuff on the shelf, so they're going to lower the prices. But advertising is something that they cut first when there is a recession fear. So Google absolutely has more fear in the short term, where the prices may go down further. And that's why I will not play any options on Google or Amazon. I'll just buy pure stock. I mean, I highly, this is my plan has been. I was big in options last year, but that time has sailed, that time has gone. I still have some calls for January 2023 on Google, which I'm losing big time. And I hope that when the split comes in July, we might recover some, but I don't have much high hopes from recovering my money on those. That's why I'm just sticking to pure stock right now. So again, I hope I provided some value. Let me know in the comments if you know any companies that you think are recession proof and we are going to see some huge price, or we are going to see some another I would say a positive movement on those companies. Let me know in the comments below again. And if you'd like to be a part of our Discord and Patreon, links are in the description below, and also take advantage of few free stocks from Momo, links are in the description below. Thank you so much for joining me. Again, a quick update. It was a very interesting article. If you get a hands-on, definitely check it out. Until next time, you all have a sparkling day.